Balanced funds are the most popular category of funds in the industry. Let's unpack why by looking at 5 key benefits of these funds. A balanced fund is categorized by its diversification across asset classes such as equities, bonds, and property. Diversification has the potential to firstly reduce risk, as not all asset classes will behave the same as different market scenarios play out, and secondly, enhance returns by broadening the opportunity set. The majority of South African balanced funds provide further diversification benefits via exposure to offshore markets. The rand is a volatile currency that strengthens or weakens meaningfully over relatively short periods, making a blended portfolio of local and offshore assets a sensible strategy for many long-term investors. The international exposure also gives investors access to growth sectors and regions that benefit from mega drivers such as innovation, industrialization, and urbanization, as well as to potentially better businesses with better earnings prospects. Many balanced funds are aimed at investors saving for retirement. Regulation 28 sets the rules for how a retirement fund's investment portfolio can be constructed. Its more meaningful limits include a cap of 75% exposure to shares and 45% to offshore investments. Many investors may wonder whether this 45% is sufficient. We believe that this limit is appropriate for an investor with the objective to one day use their portfolio to fund a retirement income in rands. Quantitative research shows that the optimal level of offshore exposure is around 40% for investors before retirement. These are investors with a larger ability to take risk and who are therefore less concerned about the variability of returns in any given period. This allows them to target a higher real rate of return, as we do in a fund like Coronation Balance Plus. For those in retirement, they need to carefully match their annual income to their rand expenses and therefore need to invest a little more conservatively. In this case, the studies recommend that average offshore exposure that is closer to 30%. You can therefore expect somewhat less offshore exposure in our more conservative balanced funds, namely Coronation Capital Plus and Coronation Balanced Defensive. We recently conducted a survey which shows that on average, financial advisors agree with this view. When asked what they deem to be the optimal strategic offshore exposure for their pre-retirement clients, the majority considered an allocation of around 40% to be ideal. The fourth benefit has to do with emotions at play. I'm sure many of you have heard the investment mantra of buying low and selling high. This is often quoted as an imperative to long-term wealth creation. While it may sound simple in theory, human emotions like fear, euphoria, and loss aversion make it incredibly difficult to put this into practice. These emotions tend to lead investors to do the opposite of what is required at extreme points of an investment cycle. Within a balanced fund, this very important decision is made on your behalf. Portfolio managers will increase and decrease exposure to the various asset classes in response to their relative attractiveness. Occasionally, they may even temporarily hold relatively high levels of cash when valuations of higher growth asset classes are unfavorable. Let's look at an example that best demonstrates this. This graph shows the total equity weighting in the Coronation Balance Plus fund over time. From 2013 to 2015, we believed SA equities to be expensive and offered limited upside. As such, the fund held just over 30% in SA equity with a total equity exposure of approximately 55%. This is low, given that a normal through-the-cycle weighting to total equity in similar balanced funds is about 65%. The decision to reduce exposure to SA equity was vindicated in the years that followed, as returns from the SA equity market were very disappointing. Conversely, when prices are low and upside is high, the fund holds a much higher exposure to equities. At the end of 2022, upside to fair value was the highest it's been since the global financial crisis, and the fund therefore had the maximum allocation to equities, which is 75%. This full allocation is linked to our expectation for double-digit returns over the next few years, given the deep discounts that many shares are currently trading at in both local as well as offshore equity markets. Optimally blending higher risk growth assets like equity and property with the lower risk assets like bonds and cash is called asset allocation. This strategy is designed to balance risk and reward for investors. If done successfully, asset allocation is a substantial contributor to fund performance over time. To illustrate the value inherent in this strategy, let's look at the performance of the Coronation Balance Plus Fund. If you invested 100,000 Rand in the fund at inception just over 25 years ago, your money would have grown to just under 3 million Rand. Additionally, this return is greater than had you invested directly in either the local or global equity market over that period. Investing 100% in equities is considered a high-risk investment. The Coronation Balance Plus Fund has delivered a superior return and has done so at a reduced level of risk, given that it is diversified across the asset class spectrum and not fully exposed to equity markets. In summary, balanced funds offer appropriate offshore diversification, active asset allocation, and attractive returns for the level of risk they assume. It is also clear that allowing a skilled fund manager to manage your portfolio in response to dynamic market environments can and should add significant value to your investment over time.